Hi, good evening. Today I'm going to talk about alternate investments, which is relatively a small study session. It is the smallest one. And this may be new for a few of the candidates, but it's actually a fast growing segment of asset management. And basically, here we talk about hedge funds, private equity, venture capital, private debt, and infrastructure assets. So these are mostly for institutions and also commodities and REITs. These are mostly for institutional clients or very high net worth investors. And this requires understanding risk in a more detailed manner and the correlations and the manager selection. These are very important in this area. So we will do about like the types of alternate investments and the fee structure and basically the way the funds are or the partnerships are constituted. So types of alternate investments. There are hedge funds, as I mentioned. Uh, they contain both securities, the cash securities, as well as the derivative positions, and employ a wide range of strategies from global macro strategies to event-driven strategies. That depends on the attractiveness of the opportunity and the specialization of the manager. And you have private equity funds, which are basically they invest in startups or uh, firms that are not listed on any public exchange, or they invest in public companies with an intention to take them private. And then the venture capital funds. So these are startups or very early stage companies, most riskiest in the alternate investment universe. And then you have private debt, which is direct lending, mezzanine loans, subordinated debt, venture debt, distressed debt, and so on. And there are infrastructure assets, which are long-lived real assets, capital intensive, and they are for public use. Can be tollways, bridges, airports, and all these things. So it is usually done in the form of a PPP model, and both the government and the private sector have a stake, and the returns are in the form of cash flows over a very long term. Let's say there is a concession agreement, but ultimately the asset goes back to the public authority. So let us see how a partnership structure. So this can be in a private equity or in a hedge fund. So you have the general partner who is responsible for managing the fund, and he also puts some money, some capital, and we have several investors. They're called limited partners. So these are the fund is constituted. Now, generally, there will be a management fee. In the case of hedge funds, it's ranging from 1% to 2% of AUM, or it can be as a percentage of committed capital. Now, this is very important. This is a term used in private equity funds. Committed capital is not invested capital. It is what the LPs have committed over a period of time, maybe 4 to 5 years. But the fee have to pay on the committed capital. So, irrespective of when the capital is fully invested, they need to pay management fee based on the committed capital and not on the invested capital. This is a very important point. And then there is a hurdle rate, that is the minimum return LP must receive before any performance fee kicks in. And we have what is called a high water mark. So basically, from the point of view of LP, so that is the highest value of the fund in the past at any performance fee calculation date or crystallization date, net of fees. So only if the performance at that date is higher than the previous high, then performance fee is payable in the case of high water mark. If that is not there, then at every gain you have to, the LPs have to pay. A clawback provision, clawback. So basically the LPs have a right to reclaim a part of the GP's performance fee for underperformance later. So this is a control on the GP for poor performance at a later date. A catch-up clause, this is also an important thing. To understand how it actually works, I will show next slide how it works. A catch-up clause allows the GP to receive his 20% performance fee, okay, above the hurdle rate. And then every return or every gain is split 80-20 between the LPs and GP. So let us see next slide. For example, if there is a simple performance fee, how it works. Suppose investment of 10 million, and then it was sold in year 4. So for 20 million, so it has doubled 2 times, and the gain is 10 million, and the IRR is 26% per annum. So on the profit, the GP will get 20%, which is 2 million, and 8 million goes to the LP. This is a simple performance fee. However, if there is a catch-up clause, say for example, in this case, the return is 18%. So 8% hurdle rate. So that first goes to the LPs. Because the hurdle rate is crossed when there is a catch-up clause, the GP gets 2%. So basically, from the 10%, he takes his fee of 2%. And the remaining 8% is split between 80-20. So 8% of 80 is 6.4%, and 8% of 20 is 1.6%. Here there is a mistake. They have shown it as 2%. It is 1.6%. Total GP ends 2% plus 1.6, 3.6% he gets. Whereas if there is no catch-up clause, then after 8% they will not get, and the balance 10% is split 80-20. So GP ends here 2%. So if there is a catch-up clause, GP makes more money than in a case where the catch-up clause is not there. Now again, there is 2 types of fee calculation. One is the American deal-by-deal waterfall. Other one is the whole of fund waterfall example. Now in a PE fund, when there are several investments, say here there are 8 investments, and they are invested in different years, and then some are sold, some are not sold. Here investments 7 and 8 are not sold. Others are sold. So basically, the GP gets a share, 20% share, the profit. So he had 2 million, he got here 3 million, 8 million. So he has got $13 million gain. So these are in losses. This is not, of course, sold. Whereas in whole of fund, GP does not get anything until all the investments are sold. So that is a difference in the European waterfall. So European waterfall is less friendly for GPs. Okay, so